Recently, various policies have been introduced in the Australian housing market that target property investors. Whether it's rental restrictions, short-term rental surcharges, or significant increases in land tax, each policy has a clear aim to tax property investors more, support renters and first-time home buyers. Many seasoned property investors were caught off guard. Moreover, of the 1.2 million homes planned to be built within the next 5 years, a significant portion are government-subsidized affordable housing and public housing funded by taxpayers. These are often located in prime urban areas which might depress property values in those regions. The logic behind Australian property investment has shifted, and this trend is expected to last until at least May 2025. So why this shift in policy? Can property investment still be profitable? How can investors protect their interests and avoid risks? Understanding the 5 key principles for success in this new framework is crucial, especially the 5-4-1 rule. Hi there, my name is Alex. Welcome to my channel where I share information about real estate investment, economic trends, and wealth creation. If you like this video, please smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. The pandemic disrupted the traditional rules of the Australian property market. Despite economic downturns, property prices surged, with major cities seeing increases between 20% to 40%. More people found it difficult to afford homes. Due to lockdowns and border closures, many immigrants and international students left Australia, causing the rental market to plummet. At its peak, 30% of properties in popular areas near city centers and universities were vacant. Finding tenants during the pandemic wasn't just about reducing rent. There were simply no renters. Aside from the initial government incentives for first-home buyers to purchase new properties, applications for approvals for apartments, townhouses, and house and land packages declined, leading to a drop in new housing supply. The pandemic forced a significant number moving back in with their parents due to transportation restrictions and social distancing measures. Many property investors adjusted their strategies, selling off properties to cope with rental challenges. Starting in early 2022, due to the outbreak of war and international logistics constraints, Australia, already in lockdown, faced labor shortages. This led to inflation, rising cost of construction materials, and an overall increase in living costs. Coincidentally, as Australia reopened its borders to immigrants and international students, and companies called employees back to offices, previously sluggish rental areas boomed. The local demand collided with that of immigrants and students, causing rents to skyrocket. Now even locals can't afford to rent. With rising living costs, soaring rents, increasing property prices, and stagnant wages, Australians aren't happy about what they're experiencing. This was evident in the May 2022 elections when the Labour Party defeated the Liberal Party, which had been in power for 9 years. Representing the interests of the working class and advocating for social fairness, the Labour Party's rise to power saw various wage increase demands, industry-wide salary hikes, and the rollout of social welfare programs, including the construction of affordable and public housing. Where does the funding come from? Partly from taxpayers and partly from additional levies on investors and businesses, optimizing the principle of redistribution of wealth. Currently, targeting investors has become a priority for all levels of Australian government, including federal and state and territory governments. But how long will this trend last? I'd like to approach this from 2 perspectives, historical and economic. Historically, over the past 40 years, federal governance has ordered between the Liberal and the Labour parties. Starting in 1983, the Labour government led by Hawke and Keating ruled for 13 years. From 1996, Howard's Liberal government was in power for 12 years. This was followed by 6 years of Labour governance from 2007 and 9 years of Liberal governance from 2013. There hasn't been a national-level party rotation every 3 years. If we follow this trend, the current Labour government might remain in power for another term, totaling 6 years. This means the current left-leaning societal shift and crackdown on investors will continue. A significant economic event could be the only game changer. Australia's economy is currently precarious. Many believe it might enter a recession, with some business owners even hoping for one, to curb the arrogance of the working class. This arrogance is exemplified by the sentiment, "It's the employer's luck to find someone like me to work for them." Hence, there are demands for wage hikes, reduced work intensity, and even deliberate reduction in productivity. Regarding the housing crisis, the government has promised to build 1.2 million homes, but almost all real estate moguls believe this is unfeasible. If property prices and rents don't decrease and the housing supply doesn't increase, a profound economic crisis in Australia leading to higher unemployment and shattered public hopes could signal a change in political leadership. If the Liberal Party wins in May 2025, it could be favorable for businesses and investors. Of course, these are just analyses and speculations. Take it as entertainment. Regardless of potential outcomes, prudent long-term investors should always prepare for the worst. Whether the current policy momentum continues or shifts in the future, always have a contingency plan. The following 5 principles are what I recommend for property investment in the near future. Number 5, stay updated with the policy changes. Given the current pace, a new policy seems to emerge every 3 months. It's essential to stay alert, be informed, plan, and strategize accordingly. For instance, Victoria has rolled out several policies that aren't favorable for property investors. However, it's not a blanket crackdown. It's merely extracting more money from investors. Some areas of property investment are indeed disadvantaged, like the low threshold for land tax on houses, restrictions on long-term rentals, and suppression of short-term rentals. But as I've mentioned, the core of property investment remains untouched. It's just a matter of earning a bit less. Good properties are still worth investing in. New South Wales is plugging tax loopholes, somewhat squeezing investor profits. But the changes aren't as profound as in Melbourne. Queensland makes a lot of noise but has minimal action, so the investment logic remains unchanged. Western Australia also sees little change. However, the present stability doesn't guarantee future consistency. Just because there are fewer changes now doesn't mean there will be fewer in the future. It's crucial to monitor policy shifts continuously. If you want a simpler, time-saving, and more accurate approach to knowing the changes, the best way is to follow my channel. Number 4, focus on long-term appreciation. Many property investors aim for passive cash flow, the freedom to retire whenever they choose, and the ability to embark on spontaneous trips. Some investors focus solely on cash flow when buying properties, but that's not how the game of property investment works. We should prioritize appreciation in the early and mid stages, leverage, build a portfolio, expand our asset base, and then transition to focusing on cash flow towards the end. Those who emphasize cash flow from the beginning might enjoy a bit more monthly income, but property appreciation will be limited. This approach might make the daily life a tad easier but won't free you from work. Capital appreciation is where the wealth is in property investment, capable of changing your life and getting you out of the rat race. This is the ultimate goal of investment. Capital gains are tax-free, while rental income is taxable. If I had to choose, as long as I can continue to hold the property, even with a slight negative cash flow, I'd prioritize capital appreciation. Number 3, follow the people. Where there are people, there's a property market. The more people, the higher the property prices. It's that simple. There is a dedicated team of experts in my company who continuously track Australia's population movements, including international immigrants' numbers, distribution across states, and interstate population shifts and growth. Generally, new immigrants prefer Sydney and Melbourne, while interstate migrants favor Brisbane. Rapid urban population growth often spills over to development areas. Based on historical and projected population movements, we identify areas for our vision members where prices are currently low but are expected to surge in the future, ensuring they get a head start in property investment. Well, in fact, with enough research and time, anyone can understand population trends and make future predictions. You can try observing whether an area is aging or becoming younger, whether it's inhabited by elites or refugees, and consider education levels, etc. These are all factors that influence property price growth due to population dynamics. Number 2, maintain a financial buffer. This emergency fund isn't for property purchases, but to buffer negative cash flows. While property investment sees short-term fluctuations, it generally appreciates in the long run. The costs of holding property also change over time. For instance, in the past year, interest rates have risen almost fourfold. Insurance premiums have increased by 60%, and rents have gone up by 20%. Indeed, rents are rising, but many investment properties have transitions from positive to negative cash flow. Some investors have to inject money into their properties monthly. Is this a good or bad thing? Well, it depends on your perspective. Discovering that your property has a negative cash flow can be an excellent opportunity to self-reflection. Is the property as good as the agent claimed? If not, it's essential to admit it, reflect, take action, and if necessary, cut losses, sell it, retrieve cash and borrowing capacity, and reinvest in better properties. But the real concern is if the property itself is good with a long-term potential, but current negative cash flow pressures force a sale. Only with enough time can you benefit from the compound effect of investment. Selling a property disrupts this compounding, leading to much less gain. So an emergency fund ensures that you can continue holding valuable properties during crisis. Number 1, the 5-4-1 rule. This is the most important one. Through extensive research and addressing the real-world issues of numerous Vision members, we've come up with a method that can help you prioritize key factors when making property purchase decisions. This is the 5-4-1 rule. Residential property investment in Australia has its unique characteristics, distinct from any other country in the world. To succeed, the location accounts for 50%. If you choose the right location, you're already half the way to success. Think of it as boarding a train to financial freedom. Picking the right platform is your first step. Next, the duration of property ownership is 40% of the work. Analyzing the Australian property market trends from World War II to the present, we've observed that while Australian residential property prices fluctuate in the short term, they consistently rise in the long run. Even if you pay a slight premium for a property, as long as it's a good investment property, and you hold on to it long enough, it can still yield significant appreciation. Many believe that the timing of the purchase is the most important factor, but I see it as the least important, accounting for just 10%. Would you rather wait for 5 years for the so-called lowest point in the property market, or when you are fully prepared, find a suitable investment property in the current market for long-term holding? In the framework of Australian property investment, the importance of holding duration far outweighs the timing of entry. Looking back at the property market trends over the past 24 months, it's evident that we've entered a new phase, a fresh cycle. As of the end of August, the total value of residential properties in Australia reached an astonishing 10 trillion Australian dollars, an increase of 100 billion from the previous month and 200 billion from 2 months ago. The total value of Australia's residential property market surpasses Australian pensions, all Australian listed companies, and Australian commercial properties combined by 30%. This shows that the majority of Australians' wealth is tied up in residential properties. We're currently in an economic climate of high inflation, high interest rates, and low wage growth. Many are tightening their belts, cutting back, and prepare for an impending economic downturn. The media and public opinions are polarized. Many argue that now isn't the right time to buy an investment or even a home. On the other hand, seasoned investors who have weathered several market ups and downs and advocate for long-term investment believe now is an excellent time to enter the market. I couldn't agree more. Those unfamiliar with investing or looking for quick profits are concerned about interest and the market trends in the coming months. In contrast, long-term investors are thinking about property market trends several or even tens of years down the line. I hope everyone can adopt a long-term perspective and achieve financial freedom sooner. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos and follow me on social media at RealCoachAlex. I'll see you soon in the next video. Have a good one. Bye.